Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at UnitedHealth Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because today, imagine a company that is so deeply embedded in the American healthcare system that its software literally runs in 8 out of 10 hospitals.
Yeah, practically a monopoly.
Exactly. It touches almost every clinic, every pharmacy, every physician you will ever interact with.
Right.
But now, imagine that same impenetrable titan just saw its stock valuation get cut entirely in half.
Right.
Because that is exactly what we're looking at today. A fundamentally critical giant is down nearly 50% over the past year. And, usually when a company this entrenched loses that much value, you just have to assume the business model is permanently broken.
Oh, absolutely. The immediate instinct is to assume some sort of catastrophic failure. But when you actually look under the hood here, you aren't looking at a company in pre-fall. No, not at all. You're looking at a massive organization executing a really quiet turnaround. They are in the middle of this very painful but, highly deliberate transition.
Okay, so a calculated move.
Exactly. For the last decade, their strategy was pretty simple. Growth at all costs, acquire more members, expand the geographic footprint, just get bigger.
Right, the classic corporate playbook.
Yeah. But now the narrative has completely shifted. They are aggressively moving away from top-line revenue vanity. They're pivoting entirely toward bottom-line earnings quality.
And I got to say, that pivot makes total sense when you look at the sheer turbulence they experienced in 2025. Because the numbers from last year are genuinely wild.
They really are.
Their adjusted earnings per share crashed by 59% year over year. But, and here's the paradox that completely breaks the brains of casual investors.
Yep.
During that exact same 12-month period where earnings fell off a cliff, their revenue actually grew by 12%.
Yep.
How does a company bring in 12% more cash and simultaneously watch its profits just evaporate?
Well, it's the ultimate real-world lesson in the mechanics of the insurance business. It perfectly highlights what went wrong for them last year.
Walk me through it.
So, when an insurance company brings in more revenue, it simply means they are collecting more premiums from new members. On day one, that looks amazing on an income statement.
Sure, you've got billions in new cash flowing in.
Right. But the actual product you are selling is a promise to pay for those members' medical care over the next year.
Right.
So if the cost of the hospital visits, the surgeries, the prescription drugs for those new members ends up being higher than the premiums you collected, well, your revenue will look fantastic while your actual earnings completely bleed out.
Oh, wow. So they brought in a tremendous amount of top-line cash in 2025, but the underlying cost to actually service that volume was totally misaligned.
Exactly. The math broke.
So management looks at this 59% drop and realizes, okay, the old playbook is dead. The growth at all costs era is over.
Very over.
And to fix it, they've set a revenue target of over $439 billion for 2026. But more importantly, they drew a line in the sand for profitability. They raised their 2025 earnings guidance to a baseline of $16.25 per share.
That's the anchor number right there.
But the way they plan to achieve that feels entirely counterintuitive. They are proactively kicking people off their insurance plans.
Yeah, it's radical.
They're targeting the removal of up to 1.4 million Medicare and Medicaid members. And total projected membership losses could actually reach 2.8 million.
They are deliberately shedding unprofitable contracts.
It's like, think of a massive cargo ship that realizes it's taking on water. They aren't just trying to patch the hull. They are actively throwing their least profitable cargo overboard just to keep the ship moving fast enough to reach the port.
That is a perfect way to visualize it.
Shrinking your user base by millions of people sounds like a CEO's worst nightmare. But in this context, it's pure survival.
It is. And the metric that measures how much water the ship is taking on, that's called the medical care ratio.
Okay.
This is arguably the most important number in healthcare finance. It measures the exact percentage of every premium dollar that the insurer actually spends on medical claims and healthcare quality.
So if you collect $1 and you spend 90 cents on medical care, your ratio is 90%.
Exactly. And you keep 10 cents to cover administrative costs and profit. Right now, their medical care ratio is sitting at 89.1%.
Which is high.
Too high. So by throwing that unprofitable cargo overboard, those specific Medicare and Medicaid contracts, they project they can lower that ratio to 88.8%.
Wait, going from 89.1 to 88.8%?
That-
To the average person listening, a 0.3% drop sounds like a rounding error.
Right, but at a scale of $400 billion?
Yeah, a fraction of a percent is a staggering amount of money.
It is billions of dollars in retained capital. By letting go of the volume that was actually costing them money to service, they instantly increase the overall quality of their earnings.
It's addition by subtraction.
Precisely. It is a painful adjustment, which is why the stock took such a severe beating in the first place, but it establishes a much healthier, highly profitable baseline for the future.
But throwing cargo overboard only keeps you afloat.
Right.
It doesn't fix the engine. Eventually, if you want long-term greatness, you have to fundamentally change your cost structure.
You do.
And this brings us to what I find, honestly, the most fascinating part of this turnaround, the technology play. Because despite the massive drop in earnings last year, their core cash generation didn't actually stop.
Not at all. And this is a really crucial distinction between accounting earnings and actual liquidity.
Right.
Despite the 59% drop in earnings per share, the company still generated $19.7 billion in operating cash flow in 2025.
Which just feels like magic to someone outside of finance. Like, you lose half your earnings but somehow generate nearly $20 billion in cash.
It's wild.
But that comes down to the timing of the insurance model, doesn't it?
Yeah.
You collect the premium cash up front today, and you don't pay the medical claim until months later. Plus, you have massive non-cash accounting deductions like depreciation.
Exactly. They are sitting on a fortress of actual cash flow. They have the sheer liquidity to not just survive a turnaround, but to aggressively fund the engine repair you mentioned.
Okay.
And they are using that war chest to make a massive $1.5 billion commitment to new artificial intelligence initiatives.
Right. The star of this initiative is a generative AI platform they are calling Avery. Management claims this tool is going to slash $1 billion in internal costs.
Specifically targeting their general and administrative expenses.
Yeah, they want to cut those expenses by 20 basis points, which is Wall Street speak for 0.2%. Again, at their scale, that translates to hundreds of millions of dollars dropping straight to the bottom line.
Real money.
But I have to admit, I look at every corporate AI announcement right now with heavy skepticism. Every single company that had a bad year is suddenly claiming, oh, AI will fix everything.
Of course. Wall Street loves the buzzword.
Exactly. So how does this actually generate $1 billion in real savings? Is it just hype?
Well, the skepticism is entirely warranted right now, but Wall Street analysts aren't just taking management's word for it here. They are actually hard-coding these AI efficiencies into their forward-looking financial models.
Really?
Yeah, because the use case here is incredibly concrete. I mean, think about the sheer administrative bloat in the American healthcare system. Think about prior authorization.
Oh, man. Right. A doctor prescribes an MRI, and the patient's insurance immediately kicks it back, denying the claim.
Exactly. And what happens next? The hospital administrator has to gather the patient's physical chart. They have to call the insurance company. A human nurse at the insurance company has to manually read the doctor's notes, cross-reference them with a massive, complex insurance policy document, and then make a determination.
Which takes forever.
If they disagree, it escalates to a peer-to-peer review between two doctors on the phone. This single transaction takes days and costs hundreds of dollars in purely wasted human administrative time.
And generative AI fundamentally solves this.
Yes. A platform like Avery can ingest the patient's medical chart, instantly match it against the exact criteria of the insurance policy, and approve the authorization in 3 seconds.
Wow. 3 seconds.
When you apply that level of automation across coding, billing, and authorizations for tens of millions of patients, a $1 billion cost reduction isn't a pipe dream. It actually looks conservative.
And the reason they can deploy this so effectively is because of their specific business structure. They operate under what is known as the pay-for model.
Yes, the pay-for model.
They're both the payer UnitedHealth Group, the insurance side, and they are the provider of actual medical services through their Optum division.
That vertical integration is their absolute superpower. It creates an ecosystem that is almost impossible for competitors to replicate.
Because they own the whole chain.
Right. If a patient is insured by UnitedHealthcare, goes to an Optum urgent care clinic, and gets a prescription filled by Optum Rx, the profit margin's captured at 3 different points by the exact same parent company.
The money stays inside the family.
Exactly. And to give you a sense of their reach, 8 out of 10 hospitals and payers currently utilize their software solutions. They are completely embedded into the central nervous system of healthcare.
So when they build an AI tool to create efficiencies, they aren't just deploying it in a vacuum.
No, they're deploying it across a massive, vertically integrated network where they control both the insurance risk and the physical care delivery.
Okay, so if the AI is fundamentally lowering internal costs and management is successfully protecting their profit margins by throwing the bad contracts overboard, the natural question for anyone managing their own portfolio is, well, has the market caught on to this yet?
That's the big question.
Right now, the stock is trading around $277. At that price, we're looking at a valuation of roughly 15 times their projected 2026 earnings. Historically, for a company with this kind of moat, a 15 multiple is an enormous discount.
It is deeply discounted. What you are witnessing right now is a psychological transition in the broader market. Financial markets always move in phases.
Sure.
For the last year, this stock was strictly in the neglect and punish phase. Retail investors and funds were disgusted by the earnings drop, so they sold. But now we are entering the rediscovery phase.
Rediscovery.
Yeah. The big institutional players are doing the math on the AI savings and the margin improvements. We are seeing major upgrades. Raymond James recently upgraded them to an outperform rating with a $330 price target.
Nice.
They specifically raised their long-term earnings estimates because they believe the AI cost savings are highly credible. And UBS went even further. They maintained a buy rating with a massive $410 price target.
So we have a current price around $277, and top-tier institutional analysts putting a $410 target on it.
Yeah.
That is massive implied upside.
Huge.
And it centers around this concept analysts call a mean reversion setup. Let me see if I am looking at this right. Mean reversion is basically a bet that the market is throwing a temporary tantrum. Retail investors panic, sell everything, and drive the price down to this 15 multiple.
Right.
But eventually, the adults step back into the room, the institutions see the underlying value, they start buying, and eventually the stock's valuation is forced back up to its historical average. Am I capturing the mechanics of that correctly?
You are capturing it perfectly. Mean reversion is essentially the financial law of gravity, but operating in reverse.
I like that.
An asset's price will eventually return to its long-term historical average, its mean, assuming the business isn't permanently impaired. Institutional investors, like the fund mayors in power who have been actively analyzing this specific turnaround, they don't panic.
No, they do the math.
Exactly. They dissect the operational issues from last year. They look at the core business and realize the problems are entirely fixable. So while the retail market is panicking, these institutions start quietly accumulating millions of shares at that compressed 15 multiple.
Buying it up cheap.
By buying up all that supply, they establish what we call a value floor. They are building a foundation. Their bet is that as UnitedHealth proves this turnaround is working over the next 3 or 4 quarters, the broader market will realize their mistake and re-rate the stock back to its historical multiple of 20 or 22 times earnings.
And the journey from that depressed multiple back up to normal, that upward expansion, is exactly how you generate the upside from $277 to $410.
That's the exact mechanism, yes.
It makes total sense. It is about looking past the immediate noise and understanding how the big money positions itself for the recovery. But, we can't just look at the rosy scenario. We are talking about a perfect AI deployment and flawless management execution inside the U.S. healthcare system, which is, well, it's notoriously dysfunctional.
To put it mildly.
Right. What happens if this high-tech turnaround runs straight into real-world macroeconomic headwinds? What is the bear case that could break this thesis?
Okay, the single biggest threat right now, the reality that keeps their executives awake at night, is the massive structural disparity in healthcare inflation.
Inflation is everywhere.
But it's especially bad here. The actual cost of providing medical care right now, hospital stays, physician salaries, medical devices, is running near a 10% inflation rate. It is staggeringly expensive to deliver care today.
10%? Wow.
But on the other side of the ledger, you have the government's reimbursement rates. The government dictates how much they will pay insurers to cover Medicare patients. For the upcoming year, the government's rate increase is a meager 0.09%.
Wait a minute. If hospitals are raising their prices by 10% across the board, but the government is only increasing Medicare payouts by 0.09%, the math is totally broken.
Completely broken.
Oh, I see it now. They aren't just dropping those millions of members as some clever strategy to boost their margins. They are literally bleeding out on those contracts.
Exactly.
If they don't drop those patients, they're personally subsidizing the United States government's healthcare shortfall out of their own corporate treasury.
Yes, you've perfectly identified the crisis. They are caught in a brutal inflation squeeze between skyrocketing provider costs and entirely stagnant government reimbursement rates.
Wow.
The math forces their hand. If they do not aggressively manage that membership base and purge those unprofitable contracts, their medical care ratio won't just miss the target. It will violently spike and their earnings will collapse even further.
Which creates a massive political problem.
Exactly. And that brings us to the second major risk regulatory headwinds. Healthcare is arguably the most intensely political sector in the economy.
Oh, without a doubt.
The operational missteps they had in 2025 didn't just frustrate Wall Street investors. They severely frustrated federal regulators, hospitals, and lawmakers. They have burned through a significant amount of political capital.
So as they execute this turnaround, as they actively kick up to 2.8 million people off their rolls to save their margins, they're operating under a microscope.
A massive microscope. If regulators decide their Medicare Advantage practices are too aggressive, or if the membership calls draw congressional hearings, that political heat could create severe volatility for the stock.
Yeah, Congress loves a healthcare hearing.
They have to operate flawlessly because they have zero margin for error with the government right now.
So the tightrope they're walking is trying to execute this perfect surgical removal of unprofitable members while keeping Washington, D.C. and the regulators totally placated.
Yes, it's an incredibly delicate balance.
Given all these moving pieces, what are the specific real-world events we should be watching to see if they're actually pulling this off?
The absolute most critical proving ground will be their Q1 2026 earnings report. That is the moment of truth for the entire thesis.
Okay, so look for Q1.
Investors and institutions will be laser-focused on one single metric. Does that $16.25 earnings per share baseline hold up? If they reiterate that guidance, it proves definitively that the bleeding has stopped and the margin protection strategy is working.
And what about their growth initiatives? Are there specific business moves we can track there?
Yes, a major catalyst to watch is how successfully they integrate their recent multi-billion-dollar acquisition of Amedisys.
Right, Amedisys.
They specialize in home health and hospice care. This is a brilliant strategic move because delivering care inside a patient's home is drastically cheaper than paying for a bed in a hospital.
Makes sense.
If they can smoothly integrate Amedisys into their Optum Home and Community Care segment, it immediately bolsters that pay-the-door ecosystem we talked about.
Okay, anything else?
Finally, keep a very close eye on the broader macroeconomic labor market. We just saw March payrolls rise by 178,000 jobs.
Which is solid.
A strong, stable labor market is fantastic news for them because it means more people are employed with robust commercial health insurance through their employers. Commercial insurance is vastly more profitable for UnitedHealth than government-sponsored Medicare or Medicaid.
Got it. So we have a complex machine attempting an incredibly high-stakes internal overhaul while navigating massive inflation and political pressure. Bringing all these threads together, what is the final verdict on the opportunity here?
The final takeaway is that the current setup earns an 8 out of 10 bullish score.
8 out of 10.
Yeah, this is the textbook definition of a fallen compounder. It is a historically dominant monopoly-like company that stumbled hard, is currently trading at a highly depressed valuation floor, and is making a massive deliberate shift from vanity growth to AI-driven efficiency.
But there's a catch.
Right. Well, you must understand the investment horizon. This is a multi-year hold, requiring a 12 to 24-month perspective. You have to be patient.
Because their turnarounds take time.
Exactly. It will take several quarters for that $1.5 billion AI investment to actually translate into verified cost savings on the income statement. And it will take time for their medical care ratio to fully normalize after they shed those millions of members.
Right.
But if you have that longer horizon and you understand the mechanics of mean reversion, the asymmetrical upside from these price levels is incredibly compelling.
It really is a fascinating case study in corporate resilience. You know, before we wrap up today's conversation, there's one thought I want to leave you with, something for you to mull over as you watch this story unfold over the next few quarters.
Oh, what's that?
We spent a lot of time talking about how their software is already deeply embedded in 8 out of 10 hospitals across the country. We also explored their new Avery AI platform, which they are currently using to automate their own bottlenecks and cut $1 billion in internal administrative costs.
Right.
Well, if Avery successfully solves the massive bureaucratic bloat inside UnitedHealth, what's stopping them from turning around, packaging that exact same AI efficiency software, and selling it to the rest of the deeply strained, inflation-squeezed healthcare ecosystem?
Oh, wow. Yeah.
They might not just be fixing their own internal margins. They might be quietly building the next indispensable software product for the entire industry.
That is exactly how a dominant economic moat gets even wider. If you can solve the problem for yourself, you can sell the solution to everyone else.
Definitely something to keep a very close eye on. Thanks for joining us for this exploration into the mechanics of wealth, and we will see you tomorrow on Smart Wealth with Joshua.